Hey everybody, Marty Mazzora here. It is the 25th of October, 2025. We'll call this your end of week update. Folks, I have been spending quite a bit of time, honestly, just thinking about the setup. And frankly, there's lots to consider. And I would say what I think is a macro backdrop that could easily go notably in either direction. In the last 2 or 3 videos, I think, or recent videos, I've talked about the private credit market and issues there. I show you my chart of business development companies and private equity companies, at least the ETFs that track those, had been weakening of late, although this last week they both experienced a nice rally. Tricolor, a subprime auto lender, First Brands Group, which is an aftermarket auto parts provider, both with massive debt loads, somewhat opaque financing practices, and so forth. And these are things that really, as I said, are really getting a lot of people's attention, and they kind of smell a little bit of systemic risk. So I'm going to share with you some of the notes I've taken. These sorts of things are troubling. As I show you my notes, you'll see where I have expressed my eerie feelings that go back to Ben Bernanke in 2006 and 2007 when subprime mortgages were beginning to fracture and beginning to show weakness and so forth, where he said, no, none of this is systemic. He was quantifying the risk and so forth, and it turned out to be a historic nightmare in the global economy. Does not mean that this is going to turn out that way, and I'm going to say that it probably isn't. And the reason largely is because since then, we live in a world where there is no limit to the political will that allows for no limit of money creation, liquidity creation, to essentially paper over anything that might whiff of serious systemic risk. So let me just jump into that. We'll do the charts and stuff also. And I think you can probably tell I'm kind of doing this one on the fly because there is just so much to think about and different angles from which to approach or to think about the market. And of course, we have to think about this all within the context of managing our clients' long-term portfolios. So with regard to the issue I've just referenced, let me pull over my notes. Okay, so given the latest fractures developing in the private credit arena, while listening to all the pushback that it's not remotely systemic, that banks are as healthy as ever, yada, yada, I get this eerie feeling again. As I recall, Ben Bernanke, circa 06-07, just before the greatest financial crisis since the Great Depression, saying that subprime issues were not systemic. That said, the policy response to COVID, to the Silicon Valley Bank, etc. episodes, and so on, suggests to me that there's literally no limit to the emergency liquidity that will be made available at the point where systemic risk is evident. Thus, there will be no massive financial breakdown, although the cost of which will be structurally higher inflation far into the future. So I actually ran this by ChatGPT, believe it or not. And so, yes, we are definitely using artificial intelligence. We can get to the data much quicker. We do have to double check and triple check a lot of it. We have caught it being wrong from time to time. But topics like this are worth exploring with artificial intelligence. In fact, I think it was 2 or 3 months ago, or maybe 2 months ago, I don't think it was 3, where I did that AI bubble versus .com bubble, and I told you then that this data was produced largely from the AI engine, and that happened to be very accurate data, at least in our view. So anyway, basically, without reading you all this, it did say that the Bernanke echo, very justified, essentially just repeats what I just said. Talked about the post-COVID policy shift, talked about COVID, talked about the so-called Liz Truss moment where the Bank of England just swarmed in when the gilt, the UK government bonds, were imploding because the new prime minister said she was going to cut taxes and stimulate and do all this pro-growth stuff at a time when inflation was a serious problem. So that was like throwing gasoline onto a burning fire, and she was gone in 16 days. The quickest prime ministership in history, of course. In 2022, as I referenced that period a lot, was where U.S. stocks went down 30% peak to trough on inflation worries, not on recession worries. So the new put, financial stability, dominance, and so forth. So it basically talks about the logic behind what I'm feeling here. And that is that, in my view, it really has to do more with we're now in that labor-friendly regime, and which is essentially populism. And the powers that be and the direction of policy needs to be tilted more toward the real economy, more toward workers, less toward capital. And that was the topic of a podcast I listened to this morning, where Michael Howell of Cross-Border Capital, whose expertise really lies in the measuring of global liquidity and the interpreting of what that means for global financial markets. And my observation is they have done a phenomenal job with their market calls related to liquidity. And he's concerned. He thinks that liquidity may be peaking. He's been very, very bullish, rightfully so. But now he sees liquidity peaking into 2026. But he also acknowledges that liquidity, so to speak, or the stimulus that will be brought to bear will be much more so on the fiscal side than on the monetary side. He says that he believes that Scott Bessent and Stephen Moran, he named them specifically, are concerned about ramping, quantitative easing back up. And even though Stephen Moran is screaming that interest rates need to be a lot lower, so that, in my view, conflicts with what Howell had said. But he's contending that they are going to be very sensitive to policies that would typically just boost asset prices, like the Fed's quantitative easing, and really do not much, if anything, certainly nothing directly for the real economy. And the focus should be on federal or fiscal spending going directly into the economy, not into bank reserves, pushing interest rates lower and pushing asset prices higher. And that will, be an answer to the record, wealth inequality that people are really, very, very upset about. And that is really how capital-friendly regimes end, is with untenable wealth and income inequality and the political requirement, if you will, for survival, for certain, to cater more toward, again, the real economy and labor for a change as opposed to capital. So that would be direct injections or direct spending, a la, let's say, the big, beautiful Bill Act, into the real economy. So my point here, though, is that in the event of a crisis, monetary, fiscal, what have you, monetary will come in first, like it did with Silicon Valley Bank. But overall, to keep this train running, it's the fiscal engine that's going to be employed. Now let's go to what I just penned just right before I started this video. So this is actually from that podcast with Michael Howell. And what this chart shows is the stimulus that has been brought to bear for the economy since 2019 and what it looks like going into 2026. The red and orange colors have to do with monetary policy. The black is purely fiscal policy. Now here's my comment. If indeed this represents the quantity of stimulus that will occur during 2026, one might surmise that the next recession is not likely to occur next year. If it accurately reflects the primary source of the stimulus, government spending, one should surmise that the Fed will not be cutting rates beyond the end of this year, and that inflation and interest rates will remain stubbornly elevated. Bottom line, this is a positive scenario for the real economy, but not so much for financial markets, at least with regard to equities, where folks have made the most money of late, and that's U.S. tech stocks. Longer-term bonds would be at risk in this scenario as well. The areas to favor would be commodities and commodity producers, real estate, infrastructure plays, if we're talking fiscal stimulus, that would be industrials and materials, financials, because of higher net interest margins, because interest rates would be higher on the longer end, amid relative stimulus-fueled economic strength. Shorter-term floating rate and inflation-linked bonds, emerging market equities in commodity-producing economies. So we have representation in all of these areas, some more than others. Ironically, here I am saying that if this is the scenario going into next year, we're going to want to own commodities and commodity producers. But as I've reported to you on the last video or two, we have cut our exposure across the commodity space as it's gotten out over its skis in the short run in our view. And we're pretty tightly hedging our gold exposure right now, at least to the end of the year. But where we've added some exposure lately is in industrials. And I guess we have a little to commodities here because we've added a little bit to energy as well. And are still pretty broadly based in EM equities, which has been great for us, which is not small in terms of what's led to our outperformance so far this year. But folks, we're giving lots of thought to these scenarios. Now, you have this scenario where the private credit market says something bad may be about to occur or may be occurring over the next few months that could be systemic and really bring hell onto the economy. And that would be the makings of a recession, right? And particularly if the stock market were to take a hit. I said recently that the next recession could very much be like the 2001 recession, which was, in my view, completely brought on by a crashing stock market because we had record high valuations in the tech space, huge concentration, parallels that are too close for comfort to what this market looks like right now. Well, then, that could bring us into recession, and this would not necessarily be the right dynamic, right? Right now, we do have essentially a balanced portfolio where we have these sorts of things, which have been very, very good for us this year. I've said we have cut back in some places, but we also have the stuff that would do well if indeed the recession scenario plays out. I do think that as we get through this year and into next year, it'll be clearer, we'll have more clarity as to where the right bias should be. But, I've been sounding pretty bearish on the economy. Now I'm presenting you a scenario as I really dig deep and think through things and think about policy over the next year, where maybe the economy indeed will be okay. If it will be okay, then we're not going to get massive rate cuts. Then we're going to have a problem. In 2022, again, the market went down 30% because the Fed was not being accommodative. Quite the opposite, because they had inflation to deal with. That's why in the UK, when they said, we're going to do a lot of this, a lot of fiscal spending, well, their government bond market really just blew up and almost destroyed their pension system and everything else. But, policymakers stepped in, and that's the world we live in right now. And it's different than the world we've lived in the past few decades. So, folks, I think I'll just kind of stop rambling on that. And I just want to let you know, and this is generally for the benefit of clients. I know we have folks who aren't clients who watch these videos as well. But just want you to know that we're thinking hard and long about what we're doing here, running different scenarios, making adjustments as we need to. And, we're as concerned about, the potential downside here as we are, trying to game or trying to capture as much of the upside. The next week is going to be interesting. We've got the Fed meeting. You would not expect the Fed to get very aggressive or sound very aggressive in light of what I just presented to you. That said, I'm not so sure. We're not going to get a very, very dovish meeting. If they were to stop quantitative tightening, now that they call that QT, right now there's about $40 billion a month, most of it is mortgage-backed securities, that they are allowing to roll off the balance sheet, so to speak, without reinvesting it. So they're essentially not throwing new liquidity into the economy as $40 billion worth of the old debt matures. And the tightening, as opposed to quantitative easing, where they're using the reverse of that, buying securities and dumping tons of money in bank reserves and forcing interest rates lower and asset markets higher. QT is the opposite of that. If they were to announce this week that they're done with QT on top of the quarter point decline in interest rates, that would be very, very bullish next week. And that could be the beginning of this nice year-end rally. Honestly, that wouldn't surprise me. When I talk about this chart here and going forward, this suggests that you're not going to get any more of that past maybe a December 25 basis point rate cut. Because if you were cutting and providing more of the orange and red on top of the black, inflation would just be a real problem next year. And I just don't see the Fed doing much of that. But right now, under the circumstances, weakness in what we're seeing in private credit, some weakness in the labor market. Well, I've heard one or two commentators today say no way they'll do that this coming week. I think they might, frankly. But despite the fact that it doesn't necessarily jibe with this scenario. So that'll be interesting to see. And of course, something I'll be talking to you about toward the end of next week. Okay, so just because we always do it, let's just look at the charts real quick. Gold finally is taking a pretty good hit right here. We will see. Remember, I've been calling for a double-digit correction in gold. So if that happens, of course, we've got a lot further to go. That's why we're hedging it. Gold miners, we cut half of our exposure just before the peak right here. So it's a much smaller position for us. We're comfortable with the position right here. Long term, we're bullish, but right now it wouldn't surprise me to see, you notice how we got this big gap down, and then we're finding resistance right there at about $75 on the gold miners ETF, and you can see the congestion right here. The fact that it's losing it right there is not a good sign for the next few days or weeks, if you will, but we'll see. Silver, this is SLV, which we own as well. We cut half of that exposure as well. Although we cut that one on the way down, so we weren't as timely here. But you can see silver gapping down and then fighting with the bottom of that gap. Ultimately, these gaps will be filled, but it may not be very soon. But we'll see. Could be. Just because I was looking at it earlier, this is that business development ETF. I remember I said in the last week or so we've gotten a rally back off. This looks kind of like a bear flag to me. We've had this pretty good drop. We retraced 38% of it. If we get more problems, more announcements of bankruptcies and so forth, this could go a lot further. A lot of people say this has gone too much, too late to short it. We're not shorting it, but it's an indicator for us. So we'll see how that plays out. You can see the private equity ETF has gained a little steam here as well over the last week. And maybe this is anticipating what I just said, that the Fed's going to really ease up, and that would be, in theory, support for these kinds of companies. Leveraged loan index is gaining a little steam here the last few weeks as well. As for the S&P 500, back up to new all-time highs. You can see it closed above the all-time high. That would be bullish, technically speaking. But, we still have our rising wedge. Is that line thick enough? And we have that against long bearish divergences in the moving average convergence in the RSI. And folks, we've been looking at these patterns for years. They tend not to end well unless you can get a lot of momentum in a hurry. The QQQ tracks the NASDAQ 100 index. Nice gap into new all-time high territory. Little buy signal right here on the MACD, but you still got these momentum divergences. We'll see how they play out. Russell 2000 still fighting with that 2021 high. I like what's happening here. I like it because we add the small caps. We added a little more recently. The chart isn't quite as compelling as the breakout. You can see right here where we have a higher high, but we have momentum rolling over. So that's not a great look. But we shall see. That would be an area that I would be relatively bullish on if we did get all that fiscal spending this next year, which I presume we're going to get because of the big, beautiful bill. That would be supportive of small cap stocks. Even with the inflation, this would be a better place to be overall than, say, large cap tech stocks. The dollar is just staying right in there, just kind of button up against 99, 100 right in here. If indeed, yields are going to be higher going forward, inflation by itself suggests a weaker dollar, but you can have inflation and a stronger dollar, and higher yields. Higher yields are supportive of a stronger dollar, and that of course, all things equal, would be a headwind for our commodity ideas and our precious metals. The 10-year yield, has dropped down. I think we're right spot on, 4.0% in 10-year treasuries. We do have quite the bullish divergence in momentum, and that would suggest that the economic data is going to start improving. Dropping, would be consistent with weak economic data, but the market, or at least these technical signals, are suggesting that there could be some upside from here. That sort of thing could be problematic for equities, depending on why yields would be going up. Why would rates go higher when the Fed's about to cut interest rates a quarter point? It's going to be based on the data. If the data come in strong, although we're not getting a lot of data during the government shutdown, but if what we do get comes in strong, and when the data starts coming in, when the government reopens, comes in strong against a Fed that's being pretty accommodative as well, that would push rates higher and draw a lot of that logic into question as to why the Fed should be dropping rates, and then that would have all kinds of market implications that we will be talking about in client meetings and here on the blog. So folks, thank you for sticking with me after I edit it. I think this is still going to be pretty long, but I hope it was worthwhile for you, and I'll leave it there. Hope you have a great rest of the weekend. Talk to you next week. Bye-bye.